Welcome to Don't Retire, Graduate, the podcast that asks you what you want to be when you grow up so you can graduate into retirement with purpose and passion. I'm your host and valedictorian, Eric Brotman. Welcome to Office Hours, where we answer listeners' questions about personal finance, retirement readiness, and more. We received a question from Jake, who asked, how can I open a Roth IRA for my child? What a great question and what an important topic. I'm glad you asked it. A Roth IRA, first let's frame what that is. A Roth IRA is the type of retirement account that allows you to use after-tax dollars, deposit them in an account, grow them with no taxes along the way, and then withdraw them with no taxes on either the principal or the gains or interest for your entire lifetime. Now, there's some restrictions based on how old you are. You need to be 59 and a half to use it. And there's some other one-off restrictions. But in general, particularly early in your life or early in your career, a Roth IRA can be a godsend because you might have 30 or 40 or 50 years to grow the money and you'll never pay taxes on it again under the current tax code. So it's a home run. Now, opening a Roth for a child is not as simple as just picking an account and doing it. The child has to have legitimate income, W-2 income, in order to open a Roth. So you can't open a Roth IRA for a 7-year-old and say, oh, my 7-year-old is on my payroll and is shredding and copying all day. That won't work. But when your child is old enough to earn money, whether it's through mowing lawns or shoveling snow, or whether it's because they're working fast food or they're working in some clothing store or whatever it is, as soon as they have a legitimate job where they're going to file a tax return, they become eligible for a Roth IRA. In 2023, the limit for Roth IRAs for someone under the age of 50 is $6,500. So you're allowed to put in up to $6,500 or 100% of the child's income, whichever's greater. So if your child makes $2,000 this year, you can put $2,000 in a Roth for his or her benefit. If your child makes $10,000 this year, it's capped at $6,500. Opening a Roth for any child under the age of majority, which in most states is 18, means you're opening a custodial Roth. Now, that is different than a custodial account, or UTMA, which is the Uniform Transfers to Minors Act. That type of custodial account does not have these kinds of tax benefits. But opening a Roth for a child as soon as he or she has some income is a complete home run. So I would absolutely tell you to do that. Some custodians won't do custodial Roths and others will. So you need to check with your financial advisor or your bank or your institution where you do your investing and find out whether they will open that type of account. And then once your child reaches the age of majority, they'll take that account over. This is not one of those situations where you have to fund them every year. You're not taking on any kind of contractual obligation. So if they have earned income when they're 15, but not when they're 16, you fund it when they're 15, and then you take a year and you don't fund it. But a small amount of money growing for a long period of time with no taxes can become profound. And so I would absolutely say it is worth doing. Now, if you do own a business and you're putting your child on the payroll, make sure it's legitimate, because you don't want to subject yourself to audit. You don't want your kid to start with an IRS blemish on their record, and you want to make sure that you're above board. But assuming that that's the case, you're fine. Now, there's one other caveat that came out of Secure Act 2.0 as of January 1 of this year, 2023. And that is that if you've owned a 529 college savings plan for your child and you've had the account open for at least 10 years, and there's money left over after it's used for education, or maybe it's not used for education because of a scholarship or a different life plan, up to $35,000 of that 529 can be moved into Roth IRAs for that child's benefit, but only based on their earned income and the annual limits. So let's say you have a 529 plan, you've saved $80,000 for school, and your child goes to community college and you use some of the money, but you're left with $40,000 at the end of the day. 35 of that can be used to fund a Roth in conjunction with their earnings. And that can be a really terrific way to not sort of feel stuck that you have money that's sitting in a college plan that's not getting used. And of course, we've done shows and had guests to talk about 529s. And so I don't want to get into the weeds on that type of account, But because of Secure Act 2.0, it now lends itself toward extra flexibility, and that means funding Roths for your kids. Another thing you might want to consider, Jake, is if your son or daughter is 20 or 22 or even 25, whatever, and is earning money and they're contributing to some of their own financial well-being, their own investing, as long as they're not over the limit for Roth IRA contributions, you can still essentially gift them money and make contributions on their behalf to a Roth IRA as long as they're eligible to do so. The difference is that it would be a gift to them and it would be in their account, and it's not something that you would control as a parent because, of course, once a kid is over the age of majority, you don't have those kinds of parental rights or restrictions. So I hope that was helpful. Seek out a custodian that will do a custodial Roth IRA for a minor, if we're talking about a minor. And good luck. And Jake, good thinking, because this is something that you can really make a huge difference for your son or daughter in terms of growing some wealth and doing some tax planning along the way. So thanks for your question. If you'd like to send us a question, which we might answer on a future episode of Office Hours, please post it on our Facebook page or tweet us at Brotman Planning. I'd like to thank all of you for listening today. We'd love to hear from you, so please send us a message or leave us comments at don'tretiregraduate.com or on social media, or leave ratings and reviews on your favorite podcast platform. Thanks for coming to Office Hours. Be sure to tune in to new content every Thursday. For now, this is your host, Eric Brotman, reminding you, don't retire, graduate.
Securities offered through Kestra Investment Services, LLC, Kestra IS, member FINRA SIPC. Investment advisory services offered through Kestra Advisory Services, LLC, Kestra AS, an affiliate of Kestra IS. Kestra IS or Kestra AS are not affiliated with Brotman Financial or any other entity discussed.